Fear came back into the market in a very big way. What began as a national problem in Greece has quickly metastasized.
Down 400 very quickly, and then down 800, nearly 1,000 in a heartbeat.
I mean, it is classic capitulation.
There are some people who are proposing there was some kind of fat finger error.
We have commodities that are being crushed.
There may have been a bad print in Procter & Gamble.
This is very much 1987.
Biggest single widening day since Lehman.
There was panic selling on the way down, and all of a sudden it just stopped on a dime.
Rallying back.
On May 6, 2010, the Dow Jones Industrial Average dropped by nearly 1,000 points in minutes, erasing nearly $1 trillion from the market before rebounding. Stocks and futures were being bought and sold at lightning speed, creating a feedback loop that sent the market into chaos. It was one of the most chaotic and baffling days in financial history. As Wall Street reeled from the aftermath, few would have suspected that this unprecedented event was partly fueled by a lone trader operating from his bedroom in Hounslow, London. Navinder Singh Sarao, a man with no office, no team, and no corporate backing, was at the heart of the storm. This is the story of how he disrupted the global financial system, earning both infamy and a place in history. Navinder Sarao grew up in a working-class neighborhood, showing an early aptitude for numbers and problem-solving. After studying at Brunel University, he entered the high-pressure world of financial trading, where he quickly excelled. Sarao's transition from trading floors to working independently in his bedroom marked a pivotal shift. Armed with only a computer and his wits, he became a master of market manipulation. For years after the 2010 flash crash, regulators and market analysts struggled to pinpoint its root cause. While various theories emerged, the truth was hidden in plain sight. A lone trader in Hounslow, London, had devised a scheme that exploited the vulnerabilities of high-speed trading. At the core of Navinder Sarao's operation was a technique called spoofing. This strategy involved placing massive fake orders on the market, orders that were never intended to be executed. These deceptive trades created the illusion of market demand, tricking other traders and algorithms into reacting. Here's how it worked. Sarao would place large sell orders to drive prices down, only to cancel those orders at the last moment. This allowed him to buy at artificially low prices. Moments later, he would reverse the strategy, placing fake buy orders to drive prices up, then selling at a profit. The cycle was relentless, precise, and highly effective. Sarao didn't accomplish this manually. He commissioned custom software that automated the process of spoofing, enabling him to flood the market with fake orders at lightning speed. This software gave him an unprecedented edge, allowing him to manipulate the prices of futures contracts on the Chicago Mercantile Exchange. On May 6, 2010, Sarao's spoofing played a significant role in destabilizing an already volatile market. As stocks and futures were bought and sold at breakneck speed, Sarao's trades amplified the chaos, creating a feedback loop that contributed to the flash crash. By the time markets recovered, nearly $1 trillion in value had been wiped out in mere minutes. Yet, despite this colossal impact, Sarao managed to avoid detection for 5 years. His ability to operate under the radar was remarkable. Regulators were focused on systemic issues and high-frequency trading firms, not a solitary trader working from his bedroom. During this period, Sarao continued to trade, earning tens of millions of dollars while perfecting his craft. Sarao's actions weren't just about exploiting market inefficiencies. They revealed a glaring weakness in the global financial system, a system increasingly dominated by algorithms and high-frequency traders, where a single individual could disrupt markets on an unprecedented scale. While Sarao's strategy may have seemed like a stroke of genius, it ultimately exposed the fragility of financial markets and the ease with which they could be manipulated. This fragility would soon bring Sarao face-to-face with the full force of international law enforcement. For years, Navinder Sarao operated undetected, earning millions through his sophisticated manipulation of the markets. But in 2015, authorities finally caught up with him. The U.S. Commodity Futures Trading Commission and the FBI had been quietly investigating the flash crash, and their trail led them to Sarao's modest home in Hounslow, London. On April 21, 2015, Sarao was arrested and faced a barrage of charges, including market manipulation and spoofing. U.S. regulators alleged that Sarao had illegally earned $70 million using his deceptive trading tactics. The case quickly made headlines around the globe, sparking debates about the ethics of financial markets and the effectiveness of regulatory oversight. Facing extradition to the United States, Sarao eventually pleaded guilty to wire fraud and spoofing. However, his case took an unexpected turn. Sarao cooperated extensively with authorities, providing invaluable insights into the opaque world of high-frequency trading and helping regulators better understand market vulnerabilities. In 2020, citing his cooperation and a diagnosis of autism spectrum disorder, the court sentenced Sarao to 1 year of home confinement. The sentence was lenient, considering the scale of his market manipulation, but it underscored the complexity of his character, a trading prodigy who thrived in a system riddled with flaws. Sarao's actions exposed critical flaws in global financial markets, highlighting how vulnerable they were to manipulation by a single individual. His case became a wake-up call for regulators, traders, and policymakers alike. Navinder Sarao's story is one of contradictions. On one hand, he was a brilliant trader who outsmarted the world's most advanced financial systems from a modest bedroom in London. On the other hand, his actions caused widespread chaos, erasing nearly $1 trillion in market value in minutes. His case forced the financial world to confront uncomfortable truths: the fragility of markets dominated by algorithms, the limitations of regulatory frameworks, and the ethical gray areas of trading. Was Sarao a villain who exploited the system, or was he a scapegoat, revealing deeper systemic issues? Today, Sarao lives a quiet life, far from the chaos of Wall Street. But his legacy endures, a reminder that even the most complex systems can be disrupted by a single individual. The flash crash wasn't just a financial event. It was a moment that reshaped how we view the markets and those who wield power within them.